retail was one of the hardest hit real estate product types in all of 2020 as mandatory store closures swept the US and the world, and e commerce became the go to for consumers at a faster pace than ever before. But as the world begins to open up again on a wider scale in the second half of 2021, retail is starting to show some really encouraging signs of life again, some of which make this sector one of the most exciting product types in all of commercial real estate. So in this video, what we'll do is talk through exactly why I think retail could be one of the most encouraging asset classes in the entire industry heading into 2022, and with that, the specific potential opportunities I see on the horizon for retail real estate investors throughout the rest of 2021 and into next year. So while other asset classes like industrial and multifamily are seeing pricing creep up to astronomical levels right now, most commercial real estate investors still seem to be extremely hesitant about jumping back into the retail space. According to the CBRE Q1 2021 US capital markets figures, total retail property investment in the US dropped by almost 42% year over year between Q1 2020 and Q1 2021, and some geographic markets got hit even harder than this, with metros like Phoenix, Charlotte, Houston, and Chicago all seeing even more significant decreases in year over year investment volume. However, at the same time that we've seen investment activity in the sector decrease, we've also seen a significant uptick in some key retail health figures, which make this property type one of the biggest potential value arbitrage plays in all of commercial real estate right now, when many other product types feel more efficiently priced than they ever have before. And behind this opportunity in the retail space, there are really a few main metrics that are forward indicators of growth that could potentially lead to increased leasing activity, rent growth, and value growth in the sector heading into the second half of the year. The first key thing to note here is that retail sales have come storming back in the first half of the year, with stimulus checks and the reopening of many major markets making a huge impact on consumer behavior in the winter and spring of this year. According to the CBRE US Retail Q1 2021 figures, total retail sales volume grew by 14% year over year between Q1 2020 and Q1 2021, with clothing stores, furniture stores, home improvement retailers, sporting goods stores, and bookstores all seeing year over year sales growth of over 10%. And using the latest monthly figures, these numbers are continuing to trend upward at an even faster pace than we saw in the entirety of Q1 of 2021, with the CBRE US Retail Recovery Indicators report from May reporting that total retail sales were up 28% year over year in March alone, and food and beverage sales were up 36% year over year in that same month. And as more and more restrictions are being lifted as we head into the second half of the year, these figures are only likely to increase over the next 6 months as travel continues to pick up and consumer spending continues to reflect that pent-up demand from the last 18 months. Retail sales numbers have actually been so strong so far this year that the National Retail Federation actually revised its annual forecast for 2021 midway through the year, bumping their previous projection of 6.5% growth to almost double that figure to an expected range of 10.5% to 13.5% retail growth for the year. And with e-commerce still only representing around 20% of all retail sales in the US, this means that 80% of sales are still being made in brick and mortar locations, which is creating a massive opportunity for retailers who survived or even thrived over the last year and a half. Many retailers have already taken note of this acceleration in consumer spending, which has resulted in retail leasing activity finally starting to pick up in the first half of the year as well. According to CBRE data, retail net absorption was 17.1 million square feet in Q1 of 2021, which was a second straight month of positive net absorption in the retail sector in the US, and total retail availability decreased by 10 basis points to just 6.5% in Q1. We've also seen big names in the retail space start to show a more bullish outlook for the future, with companies like Dick's Sporting Goods announcing a new store concept earlier this month after a strong first quarter of sales, AMC announcing earlier this month that they're in talks with landlords of Shuttered ArcLight, and Pacific locations to expand their theater footprint, and even Brookfield's $5 billion retail revitalization fund investing in London-based company Electric Gamebox earlier this month with the goal of expanding into 1,000 new storefronts over the next 5 years. And much of this optimism is related directly to retail sales figures creeping back up quickly in the first half of the year, but this optimism is also directly correlated with the fact that retail rent collections for many landlords are the highest they've been in over a year. According to May collections figures from Datex Property Solutions, 94.3% of national tenants paid rent for the month, and 87.1% of non-national tenants paid rent, which was only 1.7% less than the highest figure posted in all of 2020. And even with this sudden increase in demand, the amount of new product coming online is the lowest we've seen in over a decade, with just 5 million square feet of retail completions in the first quarter of the year. And these factors, together with the fact that many retail landlords were able to negotiate percentage rent clauses in their leases during restructuring efforts in 2020, all point to signs of retail revenues and subsequently valuations increasing during the second half of the year. So if you're a retail real estate investor or looking to take advantage of the shifts going on in the retail space right now, what does this all mean for you? Well, first, I see a tremendous opportunity right now for investors who can turn around well-located retail assets, especially properties with just 1 or 2 leasable suites. Acquiring single-tenant assets with a struggling existing tenant or even no tenant at all, and then releasing that property to a healthy new tenant looking to expand in the current environment could be a great play here, especially in the resurging food and beverage space. Food services and drinking places saw sales increase by 71% year over year in May, and for retail properties located near workplaces where people are starting to return to the office, these types of assets may very well see accelerated leasing activity from the food and beverage sector specifically over the next 6 to 12 months. Retail is also a property type where some quick releasing efforts can add a lot of value in a relatively short period of time, especially through re-tenanting single-tenant assets and selling the property quickly with a long-term lease in place and guaranteed rent lined up for the next buyer. For properties that are currently owned by landlords who are tired of property ownership after all of the events of last year, going into a failing asset with a tenant in tow and then either holding the property long-term for cash flow or quickly flipping that property for a profit as soon as a lease is signed could both be very successful strategies at this stage of the cycle. Additionally, experience-based retail was the name of the game back in 2019, and with many people being cooped up in their houses for the last 12 months or more, this is even more true today in 2021. Again, people are looking to re-engage with their communities and travel again, and with year-over-year TSA checkpoint travel numbers consistently clocking in at 3 to 5 times higher than those from the spring of 2020, as well as 2021 figures still coming in at a full 20 to 25% below normalized 2019 numbers, it looks like there's still a lot of room to run in travel and experience-based retail. And even for those who got used to the way things were in 2020 and plan to continue making most of their purchases online, major retailers who were successful throughout this time period are also investing heavily in what are referred to as omni-channel strategies, essentially enabling the customer to have multiple options to buy online and pick up in store or return in store and vice versa. This means that well-located vacant big box retail sites could also be prime candidates for repurposing into distribution centers or potentially some sort of showroom experience where people can order in store and have a product delivered to their doorstep. Retail delivery is a game of speed right now, and micro-fulfillment centers allow companies to get products to customers quickly in those last-mile locations where traditional retail sites already tend to be. Overall, I see a ton of opportunity in the retail space over the next 12 to 18 months, and if you're looking for an opportunity in commercial real estate and feel priced out of industrial or multifamily deals right now, I hope this was helpful in giving you a fresh perspective on retail and the kinds of changes that are currently happening in the sector and how investors might be able to profit from these shifts. And if you're looking to learn more about how to analyze retail deals, or you're trying to land a job at a retail real estate investment or brokerage firm, make sure to check out Break Into CRE Academy, which will give you instant access to courses on retail real estate investment analysis and valuation, sample retail acquisition case studies, pre-built downloadable retail acquisition and development models, and you'll also get access to members-only private email-based career coaching if you're looking to break into the real estate industry and need some personalized guidance to help you get there. And if you like this video and want to see more videos on different real estate product types like this one, make sure to hit the like button to let me know, and let me know in the comments where you see retail going over the next 12 to 18 months. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.